This is my issuer, right? And this is the investor. Now, issuer would sell the bond or issue the bond to the investor, and the investor in turn would pay the issue price to the issuer, pay the issue price to the issuer to buy the bond. Now, these are the cash flows that occur, right? These are the cash flows. This is how cash changes hand at issuance of a bond, right? Now, subsequent years, what happens is again I'll make those triangle rectangles again. Right, in subsequent years, what would happen is that issuer, investor, in subsequent years, what happens is that the issuer would pay to the investor fixed interest payment known as coupon payments. Right, so issuer would pay the investor fixed coupon payments, fixed interest payments, which are known as coupon payments, and these coupon payments would be made at regular intervals, and these coupon payments are also a fixed percentage of face value. And at maturity of the bond, what will happen is that the issuer will repay the face value of the bond to the investor. At maturity of the bond, the issuer will repay the face value of the bond to the investor. So point to note here is that face value of the bond is this face value of the bond is not necessarily equal to the issue price. Right? It is not necessary that face value of the bond is equal to the issue price. See, Ayush has sent a message. What message has he sent? So he will take some time maybe to. Okay, guys, so this was the idea that were discussing yesterday as well. Now, whether the bond would be issued at a discount or a premium or at face value, that would be dependent upon the coupon rate and the market rate of interest for similar bonds at the time of issuance. And when I say similar bonds, I mean bonds with similar credit rating. Right? So, whether the bond would be issued at a discount, premium, or a par would depend upon the coupon rate and the market rate of interest for similar bonds at the time of issuance. And when I say similar, I mean similar in credit rating. Right? Guys, market rate of interest at time of issuance. Time of issuance is a very important word, right? It is a catchword which will come in handy later. So, market rate of interest at time of issuance is also known as effective interest rate. Very important point. It is also known as effective interest rate. Now, let us take an example which we have taken yesterday as well. Say XYZ company issues a $100 face value bond, right, at a coupon rate of 5% and the bond will mature in 3 years. And the effective interest rate or the market rate of interest for similar bonds today is 5%. Right? Market rate of interest for similar bonds is say 4%. So guys, will this bond be issued at a discount or premium?
Premium.
Yes, this bond will be issued at a premium. Why? Because bonds with similar credit rating to that of XYZ company are paying 4%. This bond that is being issued by XYZ company is paying 5%. Right. So since the bond being issued by XYZ company is giving more than similar bonds in the market, bond of XYZ company would be issued at a right. So guys, the thumb rule is that when coupon rate is greater than market rate of interest of similar bonds, bond will be issued at a premium, right? And the idea that why will it be issued at a premium? Because this company XYZ is issuing a coupon that is giving a higher interest rate or that is giving a higher higher interest compared to similar bonds in the market, right? So that is why it would be issued at a premium because investors would be attracted to buy such a bond, right, which is giving more interest than similar bonds in the market, right? Now let us look how the cash flows will look for such a bond. Is so again issuer and here would be the investor. So guys, issuer will issue the bond to the investor, right? Issues the bond and the pay the investor would pay the issue price to buy the bond. And subsequently, guys, what would happen is that this would happen at issuance. Subsequently, what would happen is that the issuer, again, let me draw these rectangles. The subsequently, what would happen is that the issuer would pay fixed interest payments or coupon payments to the investor. Right? It would pay coupon payments to the investor, and it would also pay the face value of the bond at maturity. These coupon payments would be made at regular intervals, and at maturity, the issuer would repay the face value to the investor. Right? What would be the amount of interest, or what would be the amount of coupon that the issuer would pay to the investor? Guys, look at the example. Say this is an annual bond. So, what would be the coupon that the issuer would pay to the investor?
$5. That's 50.
$5, right?
Five. Okay.
Every year, issuer would pay a coupon of face value, right? Always remember coupon is a percentage of face value. So face value into coupon rate, which is 100 into 5% or $5, right? So at the end of each year, right, the issuer would pay $5 to the investor, right? So dollars five at the end of year one, dollars five at the end of year two, and dollars five at the end of year three, right? So at the end of the third year, the bond would mature and there would be no remaining cash flows after that. And the issuer would also pay the investor the face value of the bond at maturity. Right, and the maturity is in 3 years. So the issuer would pay investor dollars at maturity, or it would pay $100 to the investor at the end of 3 years. So the cash flows receivable by the investors, by the investor would look something like this, right? Issuer would pay the investors $5 in coupon at the end of each year for the next 3 years, and it would also repay the face value to the investor at the end of the third year. Basically, the third year is my maturity. So cash flows are something like this. Guys, please remember, issuer will not pay the issue price of the bond to the investor at maturity. We do not pay the issue price. We pay the issuer would repay the face value, right? It would not repay the issue price to the investor at maturity. This is a very important point. Investor, this is something, okay, the issuer would repay face value and not issue price to the investor at maturity. So guys, these are the, these are how the cash flows would look for the investor. Right? These are the cash flows that would be receivable by the investor, or these are the cash flows that the investor would receive, right, during the life of the bond. Coming back to our discussion, right? Guys, what would be the issue price? Please tell me. What would be the issue price?
$100.
Issue price would be the present value of all cash flows that are payable by the issuer to the investor, discounted at the effective rate of interest or the market rate of interest at the time of issuance, right? So it would be the present value of these bracketed cash flows discounted at the effective rate of interest. Effective rate of interest is nothing but the market rate of interest at the time of issuance, right? So guys, let us calculate the present value of this, right? N is equal to 3, right? Market rate of interest at time of issuance is 4. So my I by Y would be 4, right? This bond would pay me a coupon of $5 every year. So my PMT or my annuity would be $5. Face value would be 100. Sorry, future value would be 100. CQT PV, right? Please calculate this, guys.
102.77.
This we had done yesterday as well, right? So we can see that the bond is, present value of this bond is 102.77. This PV is nothing but the issue price. This PV is nothing but the issue price of the bond, right? And we can see that the bond is being issued at a premium. Why? Because this bond is offering more coupon than similar bonds in the market. Right? This bond is offering me 5% coupon, but other bonds with similar credit rating in the market are offering me 4%. So since it is offering me more interest, it will be issued at a premium, right? Because investors would be attracted to buy such bonds. Right? And we can see that this bond is being issued at a premium of 102.77 minus 100, or $2.77, right? So this bond is being issued at a premium of $2.77 to face value, right? So it is being issued at a premium $2.77 to face value, guys. Face value is sometimes also known as par value. Par value, face value are the same thing. So par value is basically a synonym for face value. Right? Now, guys, what is happening here basically the issuer is issuing debt, right? By issuing these bonds, the issuer is basically issuing debt, or in very raw terms it is taking a loan from the investor, right? Guys, can we understand this? In very raw terms, if we speak, the issuer is taking a loan from the investor, right? and in lieu of the loan, it is making coupon payments to the investor. Guys, can we understand this? That this bond proceed is nothing but a loan. This issue price that the issuer receives is nothing but a loan that the issuer is taking from the investors. And in lieu of this loan, the issuer has to pay coupon payments over the life of the loan. Guys, can we understand this, please? Guys, are we good
Yes,
here?
sir.
Are all of us good at this point?
Yes, sir.
Now, guys, what happens is that these bond proceeds or these bond proceeds or this issue price that the issuer receives will be booked as a bond liability. Will be booked as a bond liability in the books of the issuer. Will be booked as a bond liability in the books of the issuer, right? Now, with this particular reading, we are basically understanding the accounting treatment for issuing bonds in the books of the issuer, right? So, this issue price or these issue price or these bond proceeds that the issuer receives by issuing the bond would be booked as a bond liability in the books of the issuer, right? And this bond liability would be classified as a non-current liability. This bond liability is a non-current liability. And guys, since the issuer is making interest payments to the in it's making interest payments to the investor every year up till maturity, the issuer would also book an interest expense in the income statement. Since it is making interest payments to the investors every year up till maturity, the issuer would also book an interest expense in his income statement every year. Right? So issuer would book an interest expense in the income statement. ये तू है?
Sir, I have a
हेलो.
yes, sir. May I answer?
हाँ क्या? Yes or no?
Sir, I have a question. Like, if it's a 3 year bond, for the first 2 years, the liability is not within the 1 year period. But when we are classifying a current liability that is under 1 year or one operating cycle, whichever is earlier, then on the year of redemption, the bond, this non-current liability will turn into current liability or will remain the
No, no, no,
same.
Anup ji. It will always be a non-current liability. Right? It will always be a
Okay. So the year of redemption has got nothing to do with it.
no, 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 no.
Okay.
Right. Now, point to note, very important, guys. This interest expense is not equal to your coupon payment. Please remember, interest expense is not equal to your coupon. Right? Interest expense does not equal your coupon payment. Right? Your interest expense equals your bond liability into market rate of interest at time of issuance or your effective interest rate. Market rate of interest at time of issuance or your effective interest rate. Okay. So guys, let us understand the accounting treatment in the books of the issuer. Right now we are starting the very important point. Accounting treatment in the books of the issuer. So guys, at issuance of the bond or at initial recognition. Let me draw the balance sheet. So at initial recognition, right, my balance sheet would be something like this. I would book a bond liability which is equivalent to the issue proceeds that I received, right? Because this is nothing but a loan that I am taking from my investors. So I book a bond liability of 102.77, right? And since the issuer receives the issue price, right? Since the issuer receives the issue price from the investors in cash, right? My cash balance would increase by the amount of my issue price. So the idea is that we will book a bond liability of 102.77, which is basically the issue price of the bond. Right? And since the issuer would be receiving the issue price in cash, the balance of the issuer's balance of the cash balance of the issuer would go up by the amount of issue price. Right? So at initial recognition, both liability and asset side would increase by 102.77, which is nothing but my issue price. Guys, can we understand this, please? Any doubts? We book our bond liability of 100 to 102.77, and we increase our cash balance by 102.77, because when we issue bonds, we would receive 102.77 from my investors, right? I would receive the issue price, which is nothing but 102.77. So I would receive the issue price from the investors, so my cash would increase by 102.77. Guys, are we good here? Any doubts, please? Is anyone having any doubts?
No,
No,
sir.
sir. Good, good.
Yeah,
Yeah.
so
So,
I'm good,
you
sir. Sir.
you
you
received
received
the 102. So your
So your
cash will
cash will
increase.
increase.
And
And
then,
then,
okay,
okay,
bond
bond
liability.
liability.
Okay,
Okay,
all
all
right.
right.
Yes, your bond liability would increase by the issue price, and your cash balance would increase by the same amount, because you will receive the issue price. The issuer would receive the issue price from the investors in cash. So the cash balance would increase by the amount of issue price, which is 102.77. Right, Nana? Are we good? Nana?
Yeah,
Yeah,
I'm
I'm
good.
good.
Now, subsequent to initial recognition, right, in subsequent years. What happens in subsequent to initial recognition, guys? What will happen is that what was the premium at which the bond was issued, guys? What was the amount of premium to face value?
2.67.
Yes. Now, subsequent to initial recognition, this premium of 2.77 would be amortized over the life of the bond. Premium would be amortized over the life of the bond. I will tell you why. This premium would be amortized over the year premium. Now, basically, what would happen is that bond liability would reduce every year by the amortization of premium, and it would reduce in such a way that at maturity, right, it would reduce the bond liability would reduce by the amortization of premium, and it would reduce in such a way that at maturity, bond liability equals the face value of the bond. Would reduce in such a way that at maturity bond liability would equal the face value of the bond. Right? Guys, why should the bond liability equal the face value of the bond at maturity? Can someone tell me this? Can someone tell me this? That why should the bond liability equal the face value of the bond at maturity? So bond
bond
will
will
be
be
traded
traded
at
at face value.
very good, Sayyid. Very good. Very, very good. That is the idea, guys. Because, guys, we had discussed that at maturity, right? At maturity of the bond, right? The issuer is liable to pay the face value of the bond to the investor, right? He's not liable to pay anything else. He's just liable to pay face value of the bond to the investor. So, issuer is liable to pay only $100, right? Which is the face value in our example. The issuer is liable to pay only $100, which is the face value, right, at the maturity of the bond. He is not liable to pay the issue price of 102.77. So the liability at the end of year 3 or at maturity should be the face value, which is $100. Guys, can we understand this? Why should the bond liability equal face value at maturity? Because at maturity the issuer is liable to pay only the face value of the bond to the investor. Guys, can we understand this? Any doubts here? Guys, anyone is having any doubts? Anup ji, koi doubts?
I'm good, sir. I'm good.
Anil, Nana, Shivashish, Victor, Kunal, Sayed, anyone,
I'm
please?
good,
I'm
sir.
good, sir. Guys,
I'm good, sir.
let us make an amortization table to amortize this premium of $2.77. We want amortization table.
Sir, this would be more on the lines of an EMI. That
Yes, yes,
102
yes,
rupees has to be paid over 3 years.
yes. That is what I am going to draw now. So I am going to make this amortization table. It's something like, right. So let's make this amortization table to amortize $2.77 premium over the 3-year period. Guys, my effective interest rate is my effective interest rate is
4%.
4%. My coupon is 5%. My term to maturity is 3 years, right? And face value of the bond is $100, right? So let us start year 1. Calculation makes more sense. Guys, I hope there is no doubts up till now. Guys, anyone is having any doubts, please?
Sir, I'm comfortable.
Year 1, opening balance of bond liability, which is 102.77, right? Now the interest expense in the books would be, in the income statement would be 102.77 into the effective rate of interest. Please multiply this 102.77 into effective rate of interest. What is it? To 4% is my effective rate of interest. Guys, please do this.
The
4.1108.
4.11, right? My effective interest rate is 102.77 in interest. My effective interest rate is 4%. My bond liability is 102.77. So my interest expense that would be booked in the income statement every year would be 102.77 into 4%, which is 4.11, right? My coupon payment every year would be 5, right? And guys, the amortization in the amortization of bond liability would be 5 minus 4.11. Please deduct 5. Please deduct 4.11 from 5. How much do you get? It would be 0.89, right? And closing balance of bond liability, right? We had discussed, guys, that this is a right, and bond liability would reduce every year by the amortization of premium, and it would reduce in such a way that at by that by the maturity, the bond liability equals the face value of it, right? So by bond liability would reduce by the amortization of discount, right? So guys, please deduct 0.89 from
It will be 101,
101.
101.
Okay,
Point,
102.77 minus 0.89.
okay, okay. 100,
Guys, really fast.
2.7.
Guys,
101.88.
my closing balance at the end of year one is the opening balance of year two, 101.88. Now again, please calculate the calculate the interest expense. Interest expense would be 101.88 into 4%.
4.07. 4.07.
Right, it's coming to 4.08 for me. Right, 4 point,
Yeah, yeah.
right, 4.08. Now my uh, amortization would be coupon minus interest expense, which is 5 minus 4.08, which is 0.92. Right, and my bond liability would reduce by 0.92 dollars in year two, right? So 101.88 minus 0.92 will be
100.96. 100.96.
right. So my closing balance of bond liability for year two is 100.96, right? So opening balance for year three is 100.96, right? Interest expense would be 100.96 into 0.04. Please calculate this.
4.04.
0.04. My amortization is 5 minus 4.04, which is 0.96,
0.96.
right? And my bond liability would reduce by the amount of amortization
100
of
minus
100.96 minus
100.96 minus 96.
that would be 100. 100.96 minus 0.96, that is 100. Guys, we can see that my premium bond, right, or the premium of $2.77 was amortized over the 3-year period in such a way that the face value of the bond at maturity is, it is amortized in such a way that at the end of the third year or by maturity, bond liability equals face value of the bond. Guys, can we see this? Can we understand this, guys? Guys, are we good? Have we understood this or not?
I'm good, sir. Sir.
Guys,
I'm good, sir.
please sum up the amortization for 3 years. It should it should equal 2.77. Please check. Add the amortization of bond liability for first, second, and third year. It should be 2.77.
Yes, it's 2.77.
2.77. Guys, basically what is happening is that we are amortizing the premium of $2.77 over a period of 3 years, and we are amortizing it in such a way that at maturity the bond liability equals the face value of the bond. And why should bond liability equal the face value of the bond? Because at maturity the issuer is liable to pay only the face value of the bond to the investor, right? He is only liable to pay $100, which is the face value. He is not liable to pay the issue price or any other amount for that matter. Guys, any doubts up till here? Are we good? Guys,
I'm
are
good,
we
sir.
good?
Good, sir.
Okay, guys. So we've summed up the amortization of premium over the 3-year period, and it is $2.77, which is nothing but the premium at which the bond was issued, right? This $2.77 is nothing but the premium at which the was issued. Guys, second point to understand is that even though we are paying $5 in coupon to our investors every year, the interest expense that we are booking is basically, guys, the interest expense that we are booking in the income statement, right? This interest expense would be booked as an income, booked as an expense in the income statement. So the interest expense that we are booking is one coupon payment minus amortization of premium. Guys, every year the coupon payment, every year the interest expense is the coupon payment minus amortization of premium, right? So 5 minus 0.89, 4.11 is the interest expense for first year. Coupon minus amortization of premium is the interest expense for the second year. Coupon minus amortization of uh, coupon minus amortization of not expense. Coupon minus amortization of bond liability is the interest expense for the second year, and 5 minus 0.96, 0.96 is the amortization of bond liability for the third year is the interest expense for the third year, right? So interest expense equals coupon payment minus amortization of premium for a premium bond. Guys, similarly, we would see that every year the bond liability is also reducing by the amortization of premium. Guys, every year the bond liability is also reducing by the amortization of premium. Guys, can you see this? That the closing balance of bond liability in year 1 is 100.88, which is nothing but opening balance of bond liability minus amortization of premium, right? So guys, both the coupon payment and the bond liability are being reduced by the amortization of premium for a premium bond. Guys, can we understand this? Are there any doubts till now? Please tell me now.
I'm
Guys,
good,
are
sir.
we good?
I'm
Everyone,
good, sir.
are
I'm
all of
good,
us
sir.
crystal clear?
Yes,
I'm good,
yes.
I'm good, sir.
Okay, now let us discuss how the P&L and the balance sheet and the cash flow statement would look. Right, guys, so we'll draw the P&L, balance sheet, and the cash flow statement for each year. So the P&L in year 1, guys, the P&L in year 1, guys, in the P&L we will book an interest expense of $4.11. Right, we will book an interest expense of 4.11 in the profit and loss account or the income statement of year 1. Right, and in the balance sheet, guys, please note that in the balance sheet my retained earnings would go down by 4.11. Why? Because net income reduces by interest expense. So retained earnings also reduces by the interest expense, because net income of every year is added to the retained earnings. Right. So since net income is reducing by $4.11, retained earnings would also reduce by $4.11. Guys. Okay, guys, by how much is the bond liability changing in the first year? Opening balance was 102.77, closing balance is 101.88. So by how much is the bond liability changing in the first year?
Point eight
Point
nine.
0.89.
Right, which is nothing but the amortization of premium, right? My retained earnings is going down by 4.11 and my bond liability is going down by 0.89. And guys, on the asset side, my cash is going down by $5.
5 rupees.
Yes, which is
Yeah,
the
yeah.
coupon payment, right? My cash is going down by $5, which is the coupon payment that I am making to the investors, right? So let us add the asset and the liability side. Asset side is going down by $5 and liability side is 4.11 plus 0.89 is also going down by $5. Guys, can we understand this? So the books would tally. Why? Because both asset and liability side are going down by the same amount of $5. Are we good? Any doubts here, guys?
Yes, sir. Good. Good.
I'm good, sir.
P&L of year 2, interest expense. So let me make a line. Interest expense that would be booked is 4.08. Balance sheet, year 2. Guys, my retained earnings would go down by 4.08, right?
Right, right.
Because my interest expense is 4.08, right? So my net income would reduce by the amount of interest expense. So retained earnings would also reduce by the amount of interest expense. And by how much would my bond liability reduce? It would reduce by the
One nine
amortization of
nine two.
premium, right? Which is 0.92. Right. So 4.08 plus 0.92 is $5. Right? On the asset side, my cash would go down by the amount of coupon paid to the investors, which is $5. So again, both asset side and liability side are going down by the same amount of $5. My balance sheet is telling. Guys, any doubts till now? Please tell me. Guys, anyone is having any doubts?
Sir, I'm good.
Now let us look at the P&L of year 3. P&L of year 3, 4.04 is my interest expense. Right, my interest, so let 4.04 is my interest expense. Okay. So let me make the balance sheet. My retained earnings would go down by 4.04. Right. Guys, by how much would my bond liability go down? Guys, please tell me by how much would my bond liability go down?
In which
Sir,
year?
it's just
Zero
just
point
remind
nine
me
six.
Hmm?
0.96 third year.
Guys, here in year 3, my bond liability would go down by 100.96.
Sir,
My bond liability would basically become zero at the end of year 3, because at the end of year 3, the bond would mature, right? So the bond liability, what would happen is that investors would be repaid, right? And bond would mature and bond liability would become zero, right? And it would be removed from the books, right? My bond liability, opening bond liability is 100.96. My closing bond liability would become nil, right? So my bond liability would become, basically it would go down by 100.96. And why will it go by 100.96? Because bond has matured, investors would be repaid, so bond liability would become zero and it shall be removed from the books of accounts, right? So let us add up the liability side. 100.96 plus 4.04 is $105, right? So my liability side would go down by 105. Now let us look at the cash side. As at the end of year 3, the bond will mature. So the issuer would repay the face value of the bond as well as the coupon, right? So the face value of the bond was $100 and the coupon that was, payable to the investors at the end of year 3 was $5. So basically 100 plus 5, 105. So the issuer would have to pay the face value of the bond, which is $100, and the coupon payment at the end of year 3 is $5. So it has to pay 100 plus 5, $105 to the investors at the end of year 3. So my cash balance would go down by 105. Now, guys, why is this happening? Because at the end of year 3, the bond is maturing, right? So the issuer needs to repay the face value of the bond, and also has to pay the coupon that is payable at the end of year 3, which is 105, right? And similarly, guys, since the bond has matured and investors have been repaid, so bond liability would become zero, right? Bond, once the investors have been repaid, right, then there is no liability. Issuer has no liability anymore because it has already repaid the investors, right? So the bond liability would become zero and it shall be removed from the books of accounts, right? So cash side also goes down by 105. So this is how my P&L looks for, over the life of the bond. Guys, can we understand this, please? Are we good? Any doubts? Both asset and liability side are going down by $105 in year 3. Guys, are we good? Any doubts? Please let me know.
I'm good, sir.
Good. Anil, Nana,
I'm
Subhashri,
good, sir, for premium.
or
I'm good, sir.
Anil?
Premium bonds.
Okay. Right now, guys, let us understand the cash flow impact. Cash flow impact. Right. Guys, please remember that under US GAAP, coupon payment of $5 is classified as CFO, right? When the issuer pays this coupon of $5, right, this coupon paid would be classified as cash flow from operations, right? And uh, my cash flow from operations would reduce by the amount of coupon paid, right? So my cash flow from operations would go down by $5, right? Under IFRS, coupon payment classified as CFO or EFO. Right now, I am not talking of interest expense. Please remember, I am talking of the $5 coupon payment, right? Please remember that in cash flow statement, we will not take this amortization. We do not take amortization in KI because amortization is just like depreciation is a non-cash charge, right? So amortization won't impact the cash flow statement because it is a non-cash charge just like depreciation, right? And under both US GAAP and IFRS, both US GAAP and IFRS, guys, what happens is that when the at the time of issuance, at the time of issuance, at the time of issuance is that uh, issuer receive these bond proceeds, right? So bond proceeds or the issue price that is received by the issuer, proceeds or the issue price received by the issuer, right? Issue price received by the issuer, received by the issuer, and that issuance is classified as cash inflow to